Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, it's good to see you again. We haven't all three been here in a while.
I know, and seasons have changed. We're on the cusp of a new quarter.
I know. October starts tomorrow, too. So with that in mind, let's get to the biggest stories right now in the more than $14 trillion global ETF industry. And as we close out the month of September and the quarter, traders awaiting comments from Fed Chair Jay Powell, plus that key jobs report later in the week.
And as assets in US ETFs reach $10 trillion, we speak to Vident's Amrita Nandakumar on how the trajectory is up and to the right.
And we'll also speak to Andrea Eisfeldt. She is professor of finance over at the UCLA Anderson School of Management on how she turned a thesis into an ETF. But before we get there, as always, Eric Balchunas from Bloomberg Intelligence. He's here with us now, looking at the flows. Eric, what do we got?
Katie, Scarlett, you said seasons change, but ETF flows remain constant. Yeah, just a lot of flows into equity ETFs. Remember, bonds had like 3 weeks in a row anticipating that Fed rate cut, but now the Fed has cut. You're seeing more flows into equities again. Now, SPY's flow at $15 billion is kind of ridiculous. There's been some money moving around for tax rebalances and also some money in between the three S&P 500. So some of this is a little smoke and mirrors. I think USHY, this is legit. That's a cheap junk bond ETF. JGLO, JP Morgan continuing to hit product after hit product. $1 billion into that almost is a lot. And the Qs, that's natural as well. Let's look at the outflows, and where you're going to see the outflows is a lot of Vs. Vanguard had some rebalancing going on, so a lot of this stuff is going to be tax related. And cows, it took in $4 billion and then $4 billion goes out. That's a tax rebalancing to sort of minimize the tax hit and any capital gains the ETF might be having. But let's expand our horizons here to really look at the flows by quarter, right? Because we're at the end of September, and I was surprised. The flows had seemed robust, but not that robust. But this is the best quarter on record for ETFs at $280 billion. And moreover, even though there's been a couple ETFs leading the way, like the S&P 500 ETFs, we've seen 2,000 ETFs take in cash. Not to mention record launches already with 3 months to go, Katie. So all cylinders firing here in the ETF space.
All right, Eric, thank you. And let's keep the conversation going now with Amrita Nandakumar. She is president of Vident Asset Management, joining us on set. It's great to see you again.
It's great being back, so thank you for having me.
$10 trillion in U.S.-listed ETFs. Of course, Eric teased the possibility last week. We said we would have a party when we finally reached that number, so I guess this is it. This is the party. You think about what's coming next. What's going to fuel the next leg of growth when it comes to the ETF industry? What's going to do it?
It's just incredible, right? $10 trillion. Only 14 years ago did we hit the $1 trillion benchmark. And I think for those of us who've been in the industry for so long, we knew it was coming, and yet it's still amazing that that moment's arrived. So I think active ETFs are going to be something that we continue talking about for the next 5, 10 trillion. Financial advisors buying active ETFs more than ever. In the last 2 years, financial advisors at large, according to a recent Fidelity study, have doubled their purchases of active ETFs. So 2 years ago, 2022, about 13% allocated to active, now 29%. In terms of product development, I mean, to me, some of the best innovation we've seen is in active equity. I think asset managers of all sizes, large and small, have put out their best cooking into the market. So for me, what comes next is fixed income, and certainly at Vident, where we help firms launch ETFs that are interested in being active in the marketplace. That's what we're talking about a lot.
So issuers are racing to offer a lot of new ETFs, and oftentimes these are more complex ETFs. Do more simple ETFs actually do better as a result? I wonder, because you can get really complicated here. And then I think about research affiliates ETF made up of stocks that get deleted from indexes. It's a simple to understand concept. That I would bet, probably gets more attention.
You know, I've always said to issuers, to the extent that you can summarize the description of your ETF or the marketing of your ETF into 1 or 2 sentences, you're going to make it a lot easier for your wholesalers, and you're going to make it a lot easier for financial advisors that are trying to understand what is the purpose of this ETF and why should I be considering it for my client's portfolio. So to me, a good example of funds that have a good, stated purpose, but I think financial advisors don't quite understand them yet, is defined outcome. So there's still a lot of FAs out there that don't know what they are, don't understand how they operate, and don't realize that in some cases they could be a very useful tool in terms of managing volatility.
Now, you talk about active, and we've looked at the numbers. It's not necessarily, our grandfather's active. This isn't money going towards the new genius stock picker person. It's, as you said, defined outcome. We call them buffer ETFs, the single stock leverage stuff. And what's interesting about this is, what do you think of this concept that the ETF industry is sort of somewhat morphing into the biotech industry? It's now selling feelings, basically. So in the case of buffers, it's like eliminating worries, your worry if you're an older investor. Or single stock leverage is trying to get you some adrenaline if you're young and looking for like a quick hit. What's your take on that? That seems to be the way this, quote, active evolution is going.
I think that's a great point. I mean, when I think of innovation in the ETF industry, to me, it's kind of the sky's the limit. Right? And as long as issuers continue to listen to their clients, listen to financial advisors, and understand what are the products that I could launch that help solve their problems, whether, to Eric's point, whether it's managing volatility or wanting to double down on a conviction that they might have in a particular stock or investment idea, I think that's where ETFs really come to the rescue and say, there's one here for you.
Let's talk a little bit more about defined outcome ETFs. And we're talking about products such as buffer ETFs, for example. And Bloomberg Intelligence has sort of socialized the idea that maybe financial advisors and investors are using these as bond replacement strategies. And certainly in my own conversations, that seems to be the case. And I'm curious what you make of that, whether we should be looking to bond replacements, and do buffers fit the bill?
It's interesting to think about it like that. I think it's hard to say that there's an idea or concept like buffered ETFs that could quote unquote replace fixed income. To me, they're a great complement, right? So what are we doing here? We're writing put and call contracts, right, to help manage volatility. So we are willing to give up a little bit of the upside to help protect us on the downside, right? So in that sense, yes, we are limiting our upside. You're not going to have quite the equity returns of, just putting yourself in an S&P 500 ETF. So to me, to the extent that you're an FA that wants to be a little more cautious about volatility, there may be a role in the portfolio for defined outcome alongside fixed income.
So the macro environment, we can't forget also, of higher for longer has really led to an explosion of these buffer ETFs, these defined outcomes. Now that we're entering a new cycle, a new rate cycle, how do you see that shifting demand?
I think I see that demand growing. I mean, if you look at the total AUM of defined outcome ETFs today, it's about 50 billion, right? We just celebrated 10 trillion in assets for the entire US industry. So to me, that suggests room for growth. I think we're going to continue to see evolution of defined outcome, but also fixed income. So to the extent that people are trying to position themselves for the new interest rate environment, either they're trying to lock in yields while they can, historically high yields, or they're trying to maybe target the shorter end of the curve, limit duration. At least for our clients, we're seeing that they're putting out their own creative versions of fixed income to give investors options away from the broad bond indexes.
Let's talk about this evolution with the private assets. Apollo with a bombshell filing with State Street to have private credit. Apollo providing the backstop for liquidity. To me, this is amazing. This is kicking off what I think is a major race for the prize. We just got done with Bitcoin. Now we're on to the next race, and it's privates. You put in here that it's not an innovation, but not a product innovation, but a marketing one. I would push back a little. I just think ETFs are the package everybody wants their stuff in right now, and why not?
I think it's a great point. I will say what a lot of people do forget is that the ETF wrapper does have certain regulatory and operational limitations. So it's not as though you can just throw whatever you want into an ETF. I mean, personally, I look forward to the day that I could buy an ETF that provides me exposure to classic cars, but I don't think we're quite there yet. What's interesting about this filing is that State Street is trying to deal with the issues of illiquid securities by saying, look, we have a buyer on demand, right? Apollo is contractually obligated to provide us intraday executable firm bids up to a certain level. And so I'll be really curious to see, what the SEC thinks of that. And to the extent that they're able to get this fund out the door, I think you're right. This is the next flood of products.
Feels like there's a pretty big asterisk next to that, right?
Yeah, exactly. And it will be fascinating to see how the SEC reacts to that filing. And people would also say that the money market, ETF that just launched is also a marketing gimmick, but we'll get to that in the next block. Before we let you go, I do want to talk about distribution. This is something that we've spoken about on this show in the past, that basically it's getting harder for ETF issuers. And you have some great stats in your notes about what you're telling issuers at this moment in terms of what they need to target in terms of assets when it comes to the first 12 months of launch. What is that number, and how has it changed from maybe 5 years ago?
I think 5 years ago, for an issuer to target 25 million, even 50 million, that was pretty admirable. I think that was a realistic goal. Unfortunately, I think that's now doubled to about 100 million. Wow. You really need to be targeting 100 million in your first 12 months and have a plan for continuing that momentum. What we see at Vident is that the runway to success is maybe 18 months now. So you really have to get it right from the first time. And that's why we're constantly saying, spend enough time on your marketing and sales plan. Make sure you know how you're going to raise your assets. Don't overestimate your ability to raise assets and underestimate what it's going to cost for you to get to that first 100 million.
You can't just have a great product idea. You have to be able to sell it as well. Amrita, it's always great to speak with you. Really appreciate your time today. That, of course, is Amrita Nandakumar of Vident Asset Management. This is Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start, of course, with that big bang coming out of China in terms of stimulus. You can see it in the charts. You're taking a look at FXI here. It tracks Chinese large caps, and it's been a pretty bleak picture for most of this year. But in the last couple of sessions, so much money coming into this ETF, of course, as Chinese equities really roar back to life. We'll see how sustainable that bit is. But let's also talk about a new product coming to market. This is a really interesting one, of course, playing on that income theme that we keep talking about. The ticker here is QSIX. Basically, it's a tech ETF. It tracks the NASDAQ 100. 85% of the exposures is to the tech index, but also buys dividends in the futures markets in a bid to eke out 6 times what the NASDAQ 100 would pay out. So we'll keep an eye on that one as well. Let's also talk about another first-of-its-kind ETF, and that is the Texas Capital Government Money Market ETF. The ticker there, MMKT, great ticker. The catch here, even though it can call itself a money market fund, it doesn't maintain that stable net asset value of just $1, Scarlett. And boy, I've seen a couple tweets about it. I was going to say the industry is up in arms, but I have seen some tweets.
All right, let's talk more about this issue with Bloomberg's Emily Grafeo. So, Emily, let's go to what Katie just said. Not having that net asset value of $1. Why is that significant?
Well, it's psychologically significant, at least for a lot of investors that I've spoken to and ETF industry experts. They say that when you're using a money market fund, that's where you're parking your cash. You want that to be completely risk-free. So when you know, okay, I invested $4,000 in that cash and it's a $1 NAV, so then it looks like it's $4,000 in your account, it feels good. It feels safe. And so this ETF, like Katie said, while it does follow 2A7, which are the SEC provisions for a money market fund, it's not going to have that stable NAV. So I think that's why there's been some talk
uproar
about it. I don't know if it's an uproar per se.
We're trying to sell it here. Yeah, we had Emily on Open Interest on Friday, and Matt Miller just could not get over that dollar NAV and the fact that
he was stuck on it.
Of course, because you think money market, you think dollar NAV, but talk to us about the holdings, though, because if you take a look inside this fund, it does look like a money market fund.
That's right. So it has to have 99.5% of the holdings in cash and short-dated government securities and corporate securities, I think, as well, repos in the fund. That's different than other short-term or ultra-short-term dated bond ETFs, think like a BIL, because those are actually only mandated to have 80% of the holdings in those kinds of instruments. So this actually will have, I guess, more of a guarantee, you could say, that it's going to have the instruments like a money market fund would have.
Who is this ETF designed for? Who are they targeting?
That's a good question. When we asked the issuer, they said that they're targeting everyone. This is a fund for everyone to buy. I mean, there are definitely financial advisors that we know are pivoting more towards ETFs. They want the intraday liquidity of an ETF. So there could be a use case there. You have a large cash allocation. You want to deploy it intraday. You want to get out. You would use an ETF for that liquidity. And it is a little cheaper at 20 basis points.
Yep, 20 basis points.
Than other money market funds out
I have
there.
to say, I love when issuers tell us that their audience is everyone.
Yeah.
Their total addressable market is Earth.
I know, that's not helpful, right, when it comes down to it. Emily, thank you so much. Emily Gorfeo covering this latest MMKT ETF. All right, still ahead, we drill down into intangible assets, the thesis that is now ETFs with Andrea Eisfeldt of UCLA. And a reminder that you can listen to Eric and Joel Weber on Trillions. It is their podcast that covers the industry. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence back with us now for today's drill down, where we focus on one ETF. Eric, what do you got?
Katie, today we're looking at NXTV, which is the simplified Next Intangible Value Index. So this is a value ETF, looks for, valuation. It looks at fundamental values, but it incorporates intangible value. Okay, what is that? So that's the stuff you can't really measure on a balance sheet, like brand names, ideas, patents, goodwill, reputation. And this is a bigger and bigger debate in the quant world because price to book doesn't necessarily measure this stuff, but it's important. So this ETF tries to incorporate that. It's very low cost at 25 bips. It uses an index, but obviously the index is designed to do something that's active. It's got 1.3 million in assets. Again, it's just came out in the spring, so it's just getting started. Let's look at the holdings. So you are going to veer away from the benchmark, right? And so in this case, right now, this ETF is full of telecom, right? So it has an overweight to telecom and right now an underweight to tech. There's other sectors that are a little less overweight and underweight, but that's, again, that's what you want from your active strategy. You can see it holds about 200 stocks. Let's look at the performance since it's come out. And I'm going to put the S&P up here with it, and you can see that it's slightly underperforming the S&P. But it is beating the other intangible value ETF. There's another one on the market. I think both of these are going to probably have to start outperforming this, Katie, and I think this thing will start to get some looks, but definitely an interesting concept. I call this the dark matter of the investing world.
All right, Eric, thank you. And joining us now to talk about this ETF, I'm pleased to say we have Andrea Eisfeldt. She is professor of finance over at the UCLA Anderson School of Management. Her thesis was the drive behind this ETF. So first of all, let's talk about what are the characteristics of your typical company that has a high intangible value. Because, I mean, reading and listening to the definitions, to me, it sounds like a lot of tech names. And to be fair, you take a look at your top industry groups, it's software and it's internet names.
Yeah, that's right. And I think the backdrop for all of this is that people are talking about or have been talking about how value might be dead. And that's because value was developed back in the 90s, back tested on firms from the 70s when the economy was totally different than it is today. So the typical company that would be in a traditional value strategy would be like an energy or a financial company. But even tech or healthcare can be undervalued or can have a low price relative to fundamentals. So the idea behind Next Value is that it's going to incorporate the intangible assets, the knowledge capital, the brand capital, the organization capital into a measure of fundamentals. So you'll have your tangible plus your intangible capital, compare that to the market price when you're constructing your value strategy and you're trying to figure out what's relatively cheap versus relatively expensive. And of course, that varies over time. But the key point is that it's not true that tech and healthcare companies can't be value companies. A lot of their assets don't show up on the balance sheet. So they might look expensive when you compare market to book value or other accounting measures. But when you incorporate these intangibles that companies invest in that grow future free cash flow, those companies that are intangible heavy, they have a lot of knowledge capital, brand capital, organization capital, data, people, customer capital. They can be value companies.
And of course, you're talking about NXTV, which makes sense because that's what Eric drilled down on. But let's talk about NXTI, though, because if you apply that question basically to that ETF, I mean, where does it leave you in terms of what is your typical holding?
Okay, so NXTV is a value strategy. NXTI is a core strategy. It has a slight quality tilt. The thesis behind that strategy and that what that index does is actually overweight companies with high levels of intangible capital relative to tangible capital. So there's no comparison to market price there. It's just going to select companies that have a high amount of intangibles relative to tangible capital. The idea is that when companies invest in R&D, when they grow their data assets, when they invest in having a great customer network or a great team, they will be at the frontier of their industry. They will have an intangible asset that's going to prevent them from being competed away and also increase their future free cash flow. So NXTI is really aimed at looking to be a core product, so benchmark to a total market index, with the idea that it's going to be active. So it's going to offer diversification relative to what we are all a little bit nervous about now, that exposure, that really high exposure to the Magnificent Seven. So benchmarked to a total market index, but doing something different by tilting away from market weights towards companies that have high levels of intangible relative to tangible assets.
So this puts a lot of focus on what's intangible, but the idea of what's intangible and the valuation there is inherently subjective, isn't it?
Well, I think for some people and some strategies, it might be subjective. So I've spent the greater part of 10 years of my research career including some award-winning papers at the Journal of Finance, which most of you probably don't read, but it's our American Finance Association, the top academic research journal, which a lot of practical asset management strategies do come out of. We learn back and forth in the investment management community and the academic research community. But I've been working on measuring intangible assets for the greater part of 10 years. And I'm also standing on the shoulders of giants in the accounting industry. People who are saying that accounting hasn't changed in 100 years, but US firms really have. So all the fundamental data that you're pulling in from 10Ks, from FactSet, from Bloomberg, that is from accounting statements that haven't changed in 100 years. Let's look under the hood and see what we can learn about modern companies, their new assets, once we look under the hood into those accounting numbers.
Well, we really appreciate you taking the time and speaking to us about these pair of ETFs. That, of course, is Andrea Eisfeldt of the UCLA Anderson School of Management. And you can read about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. But sadly, that does it for Bloomberg ETF IQ. I'm Katie Greifeld, along with Scarlett Fu and Eric Balchunas. This is Bloomberg.